Welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is AMETEK Inc., ticker AME. Over the next 5 minutes, I will discuss what I think of the valuation and the quality of this stock. So let's dive right on. First up is learning the industry. So this is an electrical equipment. They said they manufacture and sell electrical instruments and electromechanical devices worldwide. Two segments, electrical instruments and electromechanical. They offer advanced instrument process, aerospace, power, industrial markets, analytical, oil and gas, petrochemical, pharmaceutical. So across the gamut of different areas, EMG segment offers engineered electrical connectors, powder metals. So this is a company that's manufacturing products, and they are supplying it to a wide-ranging number of industries. This is definitely an industrial company. Beta of 1.31, not super significant there. Share turnover 106%. First thing that jumps out to me as I look on return on invested capital is there's not a single loss over the course of the last 20 years. So that's a very good sign. You can see profitability for 20 straight years. It screams high quality, so that's good. There is some economic cyclicality here. You can see that there's, they suffered some during the recession of 2009, and there was, I think, an industrial or oil and gas recession in that 2016 timeframe, and so you can see some sort of impact from those recessionary periods, but overall, pretty strong returns on capital the entire time. So it looks like we range from anywhere from like 10% up to about 12% in good times, down to 8%. Back up to 12, down to 9, back up to 11 or 12. So pretty solid, double-digit returns on invested capital. And when you see that over the 10-year median returns, you see the return on equity is able to turn that up into like an 18% return on equity, which is really attractive because the return on invested capital in the double digits allows you to boost it even further with some debt. So it's very attractive numbers here. The PE at 29 or 30 basically is very high. So I don't like what I see with that high PE ratio, despite the fact that they have growth. So you're growing double digits earnings over the last 10 years. That's a nice thing to see. Anytime you're growing at double digits, that's a good sign. But the revenue's grown slower than that, so you're getting some benefit from operating leverage here. However, the fact that assets are growing faster than revenue, assets are growing faster than earnings, means that over time you're suffering from worse returns on invested capital. So there's a limit to how long this can be sustained without you having problems. Let's look at gross margins. So gross margins seem to be on the high end at about 35% and the low end about 32%. There's relatively low change over here. So it suggests that there is some strength to this business model because it doesn't change much year from year, but there is some change. You can see that 32% gross margin year corresponds with the dip in return on invested capital below 10%. So let's see, earnings per share going from about $1.88 to $4.25. So they've more than doubled in the decade, and so that matches up with what we would expect. And they've about 4x their dividend over time. Now, through the entire time frame, we can see return on equity above 15%, so that's a good sign. I'm liking what I see here. Operating profit every year for the last 10 years. Shares outstanding have gone down across the decade, not significantly, but they haven't gone up, so that's a good sign. Balance sheet. Let's see what we have here as far as debt. So there's not a lot of PP&E here in terms of, well, I guess it's 300 million to 700 million, so it did double, and your long-term debt's gone from 1 billion to 2 billion. Now, if we look at that in terms of the size of the business, there's basically no debt on this business. So that's interesting. Where are all the assets then? I don't know how they're getting this return on equity so high without a measure of debt. So I'm a little interested. It requires some more digging. Normally, to boost a return on invested capital from 11% to return on equity of 18%, you'd have to have a decent amount of debt to do that. But I'm not seeing that when I look at their statements. Positive cash flow every year. Again, that's a good sign. I think this is an attractive business. My concern is really with this growth in, growth in PP&E. But even then, they're using PP&E of, 787 million to produce, let's go back to the income statement, to produce, net income of $1 billion. So they're having a very strong return on tangible assets here. Let's see if we have that in the key ratios. So you got return on tangible capital employed is off the charts. 50%, 60%, 40%. So it's actually not too bad in terms of the capital intensity. I think this company is worth looking at. There's nothing exceptional here. I'd get more excited if I could get these double-digit numbers a little higher and if it was a little less cyclical. So I'm not super thrilled. I think you could put this on your watch list if you want, but since I'm not seeing anything exceptional, to me it's a little more high quality / average. And I would be really excited if the PE ratio was 10. I could be pretty excited if the PE ratio was 15, but basically the price is just too high. I'd want the price cut in half. Something in the $60 range could get pretty interesting. But where it sits at 127, I'm not interested. So for me, it's a pass on valuation, but it passes that it's a positive remarks about the quality. It's a good business quality here. So don't forget to hit the like button on this video. Also subscribe and hit the bell so you can get notifications as I upload new videos. Thank you for listening, and until next time, stop paying fees, start building wealth.